This is the Alhambra Investments Weekly Market Pulse with the one, the only Joe Calhoun.
Yeah, I don't think the world could take another one.
Well, that's good. Hey, listen, the title of your report this week was "A Most Unusual Economy." Tell me what you mean by that.
Well, I just think that it's interesting to me that people are kind of applying, um, normal kind of metrics to this thing, to this economy. Let me give you an example. Right now, durable goods orders are down 12% from the peak. Well, if we were to say that in isolation any other time in the last 30 years and said, oh my God, durable goods orders are down 12% from the peak, people would be like, oh my God, we're freaking going into a depression. 12% drop in durable goods orders is gigantic. Well, yeah, except it was coming from this giant high, where it was during COVID because people couldn't spend on services. So they spent on durable goods. They bought sofas and washing machines and all kinds of durable goods. So the fact that it's down 12% from the high doesn't mean the same thing as if it had been on trend and dropped 12%. That would be a disaster. So I just think that we have to look at this economy as being very, very unique. And maybe that was a better word than unusual, but it's unique because we haven't been in this situation before. We haven't gone through a pandemic and had this giant government spending programs and all these things, all these payments to individuals, the PPP loans, all these things. We've never had that before. The depth of that was just enormous compared to history. So I just think it's a very unique time, and you have to analyze this economy keeping that in mind. And so when you look at things that in the past have been useful in helping to decipher where you are in the business cycle, I think you got to be very careful about that because it may not mean the same thing this time.
Well, last week's unemployment numbers kind of fall into that category. I mean, we had a lot of confirmation bias, and the bulls were saying one thing, and the bears were saying another thing. How do you break that down?
Well, as I said in the piece, everybody sees what they want to see. The bulls are out there going, hey, look, we had, 300 and something thousand new jobs last month, 372, whatever the number was. Oh, that means we're not in recession. Well, you know what? Maybe you ought to check history. There have been a lot of recessions that started while employment was still climbing. I cited the one from 1973 where you went, 7 months or something of positive employment reports after the recession started officially. So, the fact that you still have job growth right now does not necessarily mean that we're not in recession. But likewise, you look at the bears, and the bears come up with their favorite metrics. They go, oh, well, the labor force shrunk. They get this from the household report. There's two reports in the employment report. There's the establishment survey and the household report. Household report is what generates the unemployment rate. And so they look at that and they go, oh, the labor force dropped. Well, yeah, you know what? It's a volatile stat. It happens all the freaking time. I put up that chart in the piece because it's like you look at it and it's like, well, that happened, 25 times between 2010 and 2020. It didn't mean recession. And it doesn't mean a recession right now. So I just think that, again, it's one of those things where people see what they want to see. They have a preconceived notion. They have an idea about what they think the economy is doing, and they're going to find the things that fit that narrative. We don't do that. We just try to look at, we try to find things that actually have some predictive value, put it that way.
What about all this talk about late cycle when they're talking about the economy? Does that mean anything?
I see this repeatedly in the things that I read. Oh, it's late cycle. It's late cycle. Well, I got to tell you, if this is late cycle, this would be like one of the shortest expansions in history. I'm not sure it's late cycle. As I said in the piece, look, I look at some of the lending things, some of the credit things, the rise in consumer lending, the rise in commercial industrial loans, just the rise in loans and leases on the bank balance sheets, and it actually looks early cycle. There are things that look late cycle. Energy stocks outperforming is a late cycle phenomenon. But, I'm just going to put something out there. Maybe, just maybe, there's some things going on today that are having an impact on oil prices and energy prices that don't have anything to do with where we are in the business cycle. There is this little thing going on called this Russia-Ukraine war. Maybe that has an impact on gas supply. Maybe it has an impact on oil supply. It's a unique situation. And I don't think you can just look at that and go, well, energy stocks are rallying, therefore we're late cycle. I think it's just a simple, stupid analysis. I think that there is the idea that we can figure out exactly where we are in the business cycle. Well, you can't do that because you don't know how long the thing is going to be. I will say this. Since really 2020, I've been saying repeatedly that we came into this COVID recession growing at 2.1% for the previous 10 years. That was the average annual growth rate for the previous 10 years, GDP growth rate. We didn't do anything during COVID to change that because the only things that changed that are productivity and workforce growth. We didn't change either one of those things for the positive. You can argue in a way that productivity growth has actually gotten worse, but that's, it's a hard thing to measure. So I don't know that I want to really say that. But the point is that if you don't change anything, you're going right back where you started. The only difference is that we've changed balance sheets. We took a lot of corporate and individual debt and moved it from those balance sheets to the federal balance sheet. The mechanism is unimportant. In a sense, it has to do with the way fiscal policy worked. We also, by the way, did the same thing at the state level between the state and federal governments because last year's Biden bill handed the states just this huge chunk of cash. I think, frankly, they didn't need. And so now every state in the union's got a surplus, and they're all trying to figure out what to do with this windfall of federal cash. So, like I said, in a sense, we took these balance sheets and made them better while making the federal balance sheet worse. Well, I think in a way, from an economic growth standpoint, having it at the federal level is probably better. But the point is that we didn't really change anything. So we're going back to that 2.1% growth rate. So how do we get there? I think that's the question we face right now. We know that the goods economy boomed during COVID and the services economy suffered. Now we're starting to see that reverse. The goods economy is starting to come back to earth and the services economy is starting to get back up to trend. Neither one of those things is done yet. Will they overshoot? Maybe. I don't know. My point is that that's where we're headed, that 2.1% growth rate. And I think that's got to be our baseline expectation. And there are some things going on that I think you have to look at and go, maybe we'll do a little bit better than that because of these things. And I pointed out some of those things in the piece.
This is probably a broad question, maybe too broad to answer, but you've said many times that our job is not to predict the future, but to interpret what's going on right now in the present. So how do you interpret the present now? What is the present for you right now?
Well, look, I think the economy is still growing. I don't think we're in recession right now, despite the fact that what I said at the beginning, that the fact that you have job growth doesn't mean you're not in recession. That's true, but I don't think we're in recession right now. We did have a negative GDP print in the first quarter. I will tell you now, I expect that GDP number to change pretty dramatically by the time you get to the final revision. For a variety of reasons. Industrial production was doing fine. Non-farm payrolls was doing fine. It was really an inventory issue. And then there's a discrepancy between what happened in the GDP figures versus what happened in the real world. And I suspect that first quarter GDP number, I'm not going to say it's going to get revised to positive. I don't think that's going to happen, but it's going to get revised to a very, very small negative, I suspect. But that's something that'll come. We'll see what happens. I think the economy is still growing. I think that when you don't have to be an economist to drive around your neighborhood or drive around your city and see that activity is still going on. Has there been a reduction in activity? Maybe in some ways, maybe at some levels, but overall, if there is a change in the economy, it's small. I think people are traveling. You look at the services side of the economy. We know that TSA throughput's back to where it was in 2019. People are traveling, and everybody, all the bears have an excuse. Oh well, yeah, but that stuff was booked 6 months ago, and they're not going to do that now because prices are up. Yeah, maybe we'll see. I don't want to. I don't think it makes sense to try to predict human behavior. It's hard. People say, there are people out there right now. Listen, think about it this way. I say we can't predict the future. I would say that economists have a real hard time figuring out the past. We're still arguing about the Great Depression, for God's sakes. That was in 1930s. If we can't figure out what happened in the 1930s, you think we can figure out what's going to happen in the next 6 months or the next year? I think that's insane. All we can try to do is figure out what's going on right now. And I like I said, I think the economy is slowing back to that 2.1% trend. It could go below that. I don't think it's going to go below it significantly, but I don't know. That's where we are right now. We're slowing back to that trend. That's my expectation. It's being met, and we'll see where we go from there. I don't want to try to anticipate anything. Look, we have a dashboard of economic indicators that we watch, and right now we've only got a couple of them that are even flashing yellow. We don't have any that are flashing red.
And what are those two?
Well, one is credit spreads. Credit spreads are at 5.5% on the high yield spread. It got up real close to 6. 5.98 was the peak, but it did come in last week. 5.5. 5.5 is a number that is kind of in between. You know, we've had in 2007, for instance, in late 2007, that number at 5.5 would be on the verge of recession. That's about where it was then. On the other hand, in 2016, we were much, much higher and didn't have recession. We've had periods of higher numbers with recession, without recession. So it's kind of in between right now. It is worrisome because it means that lower rated credits are going to have to pay a higher rate. You know, it's kind of like what I said last week too, though. I think that's one of those things that needs to happen. So that's there. The other one is the yield curve. You know, the yield curve. Well, there's not the yield curve. There's a bunch of yield curves. So when we look at history, we see that everybody wants to look at the 10-year, 2-year curve on the Treasury. So 10-year, 2-year curve is inverted by about 3 or 4 basis points right now. Well, first of all, 3 or 4 basis points is not that much. It's really not that big a deal. But we do know that curve inverts, as it is right now, prior to recession. On average, though, by the way, about 18 months prior to recession. So it's not anything that's imminent, first of all. The second thing is that the other yield curve that really has driven most of the research on yield curves is the 10-year, 3-month curve. Well, that curve is 111 basis points as of Friday. It's not even close to inverted. And every recession, it actually has a better track record than the 10-year, 2-year curve. But the point is that every recession going back to the 60s, you've seen that 10-year, 3-month curve invert, and it's not even close. So what do we have? It's another thing where it's kind of in between. We've got a 10-year, 2-year curve that's inverted by a little bit. 10-year, 3-month is not even close. So to me, that's caution. It means worry about this, but don't do anything. And I think that's the message I want to send here. People seem to think that you have these minor changes in economic stats and you've got to make big changes to your portfolio. And that is just not true. That's how you get in trouble. That's how you end up sitting, getting all the way out of the market at the bottom in 2008 and not being able to figure out how to get back in. That's the problem with that. All your moves should be incremental, first of all. It's very rare that you need to make a big move. Your move should be incremental. And on small changes in economic data, you need to most of it's noise. You just need to sit tight and watch. There are some things that are predictive, that have had predictive power in the past. I pointed out a couple of those in the piece. One of them, entrance and re-entrance to the workforce. I was stunned by this number. I had no idea. 42% of the number of unemployed are what are known as new entrants or re-entrants to the workforce. These are people, either new entrants coming out of college or wherever, they're just getting into the workforce, or they're re-entrants. They're people that were out of the workforce for some reason, and now they're coming back. That's 42% of the people that are unemployed in this country are those people. They're just going out and looking for jobs now. I take that as a very, very positive thing. And by the way, you don't see new entrants and re-entrants into the economy when it's bad. You see it at the beginning of economic cycles when things are starting to get better. It's an early cycle phenomenon. And if you look at history, you will see before every recession, going back decades, you will see that the number of entrants and new and re-entrants to the workforce starts to fall well in advance of the beginning of recession. It's still rising. So I don't think we're at the beginning of recession. And by the way, I think what I'm going to do is I'm going to start compiling a list of these things. I know what they are off the top of my head, but I don't think I've ever really shared a lot of them. So I think I might do a piece soon to kind of share some of these things that do provide some predictive value. Most of what you see in economic data, it's just noise. It doesn't mean a thing.